In our last half hour, we talked about the Federal Reserve's decision to leave interest rates unchanged. So let's take a look at what's behind the move with Rajeev Dhawan, director of Georgia State's Economic Forecasting Center. Thank you so much for being with us.
Thank you for having me.
So looking at this move, Rajeev, is the Fed basically saying this pain should fade on its own, or is that optimistic?
Well, the tariffs did not create that much of inflation. And they will create a little bit more, as he said, going forward. But the biggest issue is that the dollar has been down more than 15%, say, against the euro, 10% overall against the other currencies, which means that all the stuff that we import, by definition, will be more expensive. And that's the fear they have going forward, that that type of inflation will come in more faster when we have some tariffs on it. And the tariffs levels can also go up. It's not for sure that the levels of tariff that we have right now will remain the same. There's always been talk about, I can raise it on this thing, I can raise it on that. So those threats are still there.
And does this pause in rate cuts signal patience or hesitation?
I think this is more about patience. They use the word, the economic outlook is very uncertain, which means you don't know which way it's going to go. You see, on the employment side, in the last 1 week, you've heard the announcements about layoffs from UPS, Amazon, Home Depot, you name it. They're reducing the headquarter counts and tech counts. That means that going forward, what will be the employment growth? It's already very weak. The only job creation we have been seeing is in the areas like healthcare, social assistance, hospitality, which are not very well paying jobs, most of them. So the issue is what the landscape looks like in 3 months when we have some more numbers on employment, and then they decide, because if the employment is much weaker than what they are expecting, which I'm also expecting the employment is going to be much weaker with the revisions and everything, then they will have to cut rates.
And talk about the fears homeowners have about mortgage rates when it comes to all of this.
The main thing, the homeowners, the biggest thing is, what's the mortgage rate? So let me give you some numbers. 2 years ago in September, when the Federal Reserve first started cutting rates, the mortgage rate was 6.1%. 2 years after cutting it by 175 basis points, which is almost quarter to 2%, the mortgage rate is still the same number. It hasn't come down. In the old days, when the Federal Reserve would cut the interest rates, the short-term one, the long terms would also come down sooner or later. This time it didn't happen. In fact, in between, the mortgage rate was 7%. So the break on the mortgage rate will depend upon how many people are buying those treasuries and the mortgage-backed securities, which is not only just our pension funds and investors and all that, it's also the foreign investors. And the landscape over there is a little bit mixed on the mood. At the same time, we are running very big federal deficits, which means there's a supply of treasuries is there, which means the demand hasn't picked up, so the interest rates haven't gone down.
Okay, well, thank you for that thorough assessment of that. I know homeowners are worried. And thank you for being with us, Rajeev Dhawan. We appreciate you so much breaking down some of those numbers for us.